All right, let's jump right into this explainer where we're going to peel back the layers of probably the most famous and honestly most misunderstood financial metric in the world, the PE ratio. If you've ever looked up a stock on literally any finance app, you've seen this number. It's just everywhere. We are constantly told it is the ultimate gauge of value, but relying on it blindly, that can actually lead you straight into a massive valuation trap. So today we're demystifying how this ratio really works, when it completely falls apart, and how to look past the illusion to find out what a stock is truly worth. To make sense of all this, we've structured this explainer into 5 quick steps. First, the PE ratio explained. Second, what happens when earnings go negative. Third, the interest rate connection. Fourth, why banks break the rules. And finally, building a valuation toolkit. Okay, so starting right off with step 1, the PE ratio explained, setting our baseline. At its absolute core, the price to earnings, or PE ratio, simply shows us how much investors are willing to pay for just one single dollar of a company's earnings. Think of it kind of like buying a money-making machine, right? If a stock is trading at $20 and the company earned $2 per share over the last year, well, the PE ratio is 10. You're essentially paying $10 upfront for every $1 of annual earnings that machine spits out. It's a super quick snapshot to help you compare companies and kind of guess if a stock is cheap or expensive. But, there is always a catch. We really have to look through 2 totally different lenses here, the rearview mirror and the telescope. When most people just casually say PE ratio, they're actually talking about the trailing PE. That looks backward at the last 12 months of earnings. It's a really safe, reliable rearview mirror for mature, established companies. But say you're looking at a high-growth tech startup. The past really doesn't matter all that much. You need the telescope, the forward PE. This looks ahead at expected earnings for the very next year. Just gotta remember, a telescope is looking at a forecast, and forecasts are definitely never guaranteed. So what happens when the formula completely breaks down because a company is actively losing money? That brings us to step 2, when earnings go negative, or as I like to call it, the NAA anomaly. When a company is losing money, the math literally just shatters. It is absolutely crucial to understand that seeing an NA on your favorite stock screener is not some glitch in the matrix. It's actually a signal that the standard valuation framework just doesn't apply yet. Because the formula divides price by earnings, if earnings are negative, you get a negative number. And you literally cannot compare a stock trading at negative 40 times earnings to one at positive 40. It is just mathematical nonsense. When I was going through the research for this, the early Amazon story really stood out. Dismissing unprofitable companies can be a huge mistake. I mean, for much of its first decade as a public company, Amazon reported negative earnings. They were deliberately bleeding cash to build warehouses, capture market share, and dig this unassailable competitive moat. If you only looked at their meaningless PE ratio back then and completely avoided them, you missed out on literally one of the most significant compounding wealth creation stories in market history. And you know what? This isn't just a one-off Amazon thing. Unprofitability is actually incredibly common depending on the industry. Nearly 90% of biotech firms and over 70% of internet software companies actually operate at a loss. Meanwhile, literally 0% of established integrated oil and gas companies lose money. Unprofitability in early tech or biotech is not a bug, it's a feature. The total absence of current earnings doesn't automatically mean a stock is uninvestable. It just means you need a different magnifying glass to figure out if those current losses are secretly building a future empire. Okay, so what else manipulates this metric? Let's move to step 3, the interest rate connection, where massive macro forces take the wheel. This specific number completely blew my mind during the research. Exactly 22.4%. That is the amount of variability in S&P 500 PE ratios that is explained entirely by U.S. interest rates. Not the underlying businesses, just the rates. Let that sink in for a second. A massive chunk of a stock's valuation has absolutely nothing to do with how many widgets they sell, how visionary their CEO is, or their latest quarterly earnings report. It is entirely macroeconomic. To really grasp why this happens, just picture a giant seesaw. PE ratios and interest rates are sitting on opposite ends. If a company's earnings stay perfectly, totally stable, but the Federal Reserve decides to hike interest rates, that PE ratio is going to shrink. Why? Well, because the broader market is suddenly adjusting how much it's willing to pay for risky future stock earnings now that the totally risk-free rate of a government bond just got a whole lot more attractive. The money just naturally flows to where the yield is the safest. And the wild thing is, you can actually see this predictability play out in real time. The historical average PE for the S&P 500 is about 19.9. Fast forward to November 2022, and the actual ratio was sitting slightly higher at 20.6. But get this, based entirely on a regression model using the 3.83% Fed rate at the time, the mathematically predicted PE was incredibly close at 21.5. So the big takeaway here, if you see a market multiple expanding or contracting, you got to ask yourself, is the fundamental business actually changing, or is the Fed just moving the goalposts? All right, just when you think you've got a handle on the rules, we need to pivot. Step 4. Why banks break the rules. For heavily asset-driven sectors like banking, the traditional PE ratio is, quite frankly, practically useless. Instead, we have to look at the price-to-book, or PB ratio. This directly compares a stock's price to its book value, which is essentially its net worth. If you take all of a bank's assets, all the loans they give out, and subtract all their liabilities, meaning the deposits they owe you and me, you get the book value. For banks, the balance sheet tells a significantly truer story than the income statement ever will. Because banks operate on just massive amounts of leverage, meaning they use borrowed money to make more money. A strong PB ratio is absolutely your best friend. The entire secret sauce of banking is just managing the spread. Charging, say, 7% interest on a mortgage while only paying you 2% on your savings account. The PB ratio is by far the absolute best indicator of how safely and efficiently they're actually managing that spread and keeping bad loans off their books, even if their current earnings look totally flat. So how do we actually survive this crazy valuation minefield? Let's pull everything together in step 5, building a valuation toolkit. Consider this your massively upgraded valuation toolkit, specifically designed so you never get trapped by a single flawed metric again. If a hot tech company has an NA for its PE, no problem. Swap it out for revenue growth to see if they're actually gaining users. Check their gross margin. If it's super high, their core product is incredibly profitable, and they're just strategically choosing to burn cash on growth right now. And hey, if you want to compare two companies with totally different debt levels and tax situations, use EV to EBITDA. It basically strips away all the messy accounting noise and lets you compare their pure, raw operating power right side by side. If you want to rapidly value a money-losing company like the professionals do, here's a super simple 3-step framework you can use. First off, map out exactly how fast you expect their revenue to grow over the next few years. Second, estimate what their profit margins will realistically look like once they stop aggressively spending and finally mature. And third, apply an exit PE multiple to that future date. So instead of unfairly judging them on today's necessary losses, you're effectively pricing in their destiny. So I want to leave you with this pretty provocative thought as you go and review your own portfolio after this explainer. Are you using a hammer to turn a screw? The PE ratio is a completely fantastic tool, but it's just one tool. If you use it blindly on an early-stage startup or a heavily leveraged bank, you are literally guaranteed to get the wrong answer. Context is everything. Look beyond the single number, respect the massive macro forces at play, and build a toolkit that actually matches the business. Thanks so much for joining me on this explainer, and I will catch you in the next one.